Good morning, everyone. You are watching live market outlook for Friday, 13th of January 2012. Finally, some relief was given to euro as well as shares as yesterday's action selling the Italian and the Spanish bonds gave better than expected results, pushing the single currency as well as commodities such as gold as the main safe haven instrument higher. The Asian shares as well as euro ended higher during the overnight session, with euro hitting its near its strongest levels in a week after strong demand in Spanish and Italian debt sales tempered risk aversion ahead of another auction from Italy due later today. Also, interbank lending rates fell in a sign that worries about the credit crunch might be easing, while Asian credit markets firmed with primary market activity picking up. A greater appetite for risk weighed on safe haven gold, pushing it slightly down, dropping 0.6% after hitting a 1-month high yesterday. But also oil recovered from the sharp sell-off of the previous session on report that proposed European Union embargo on Italian crude imports would be delayed. In closely watched test of investors' confidence, Spain sold double the targeted amount of its action of a new 3-year bond and the 2 existing bonds maturing in 2016, while yields halved at Italian T-bill sale on Thursday. The successful sales raised hopes for a similarly positive result when Italy sells up to 4.75 billion euros of longer-dated bonds later today. Also supportive was European Central Bank's President Mario Draghi comment, who said that with banks' massive injection of euros into the Eurozone banking system in December had helped avoid the credit crunch, there was still scope for further interest rate cuts that also gave additional support to the market sentiment. So long-awaited bond auction during the past week that was due yesterday and today. Now the first part gave excellent results, and we can see that euro is in the strong recovery mode. Today is also Italian auction will give more clues about this. From today's calendar, we'll take a brief look. The first to come is from UK at 9:30 GMT. It's PPI input monthly expectation is no change for today, while PPI output monthly is expected to raise by 0.5% compared to 0.2% the previous month. European trade balance is due at 10 o'clock GMT, and is expected to show a widening of trade surplus by 0.7 billion euros compared to the previous month surplus of 0.3 billion euros. Across the ocean, series of trade balances coming from Canada and United States. Canadian trade gap is expected today to narrow by 0.5 billion Canadian dollars compared to 0.9 billion Canadian dollars gap of the previous week, while U.S. trade gap is expected to widen to 44.8 billion US dollars compared to the previous month trading gap at 43.5 billion US dollars. Also from United States at the same time, which is 13:30 GMT, monthly import prices, no change expected today compared to 0.7% increase in the previous month release. Preliminary University of Michigan consumer sentiment is due at 14:55 GMT, and sentiment is expected to improve to 71.2 compared to 69.9% of the previous week release. This would be all from today's calendar. Now let's take a look on the markets and see the latest developments in the currencies and the commodities. As we can see, euro is in recovery mode after finding good support at the previous low at 126.65, low of last Monday. That was marginally broken, extending to 126.60 in the late afternoon hours yesterday, where support was found, and further improvement on the positive sentiment, positive fundamentals improved the sentiment of single currency. The gain of 128, 128.17 has extended gains to hit yesterday's fresh high at 128.44, followed by shallow correction down to 128 zone, which offered good support. Also, the 20 days moving average on hourly chart contained actually this dip. Today's fresh rally through 128.44 has so far reached 128.77, keeping the positive sentiment for a further extension higher. Also significant is to mention that the latest rally broke over 50% Fibonacci retracement of the latest down move from 130.75 high of 3rd of January down to 126.60 yesterday's low. That gives prospect for a further extension higher. And next levels to come, it's at 129, 129.20. It's a low of 30th of December, and 61.8% Fibonacci retracement of the entire move lower. That break of which would give additional boost and ease the current bear pressure, actually would provide a relief to the single currency for possible retest of next strong barrier at 130 zone. On the downside, the immediate support is at 128.44. That has already been briefly retested ahead of a higher platform of overnight session at 128 zone. That is basically expected to contain the corrective dips as the hourly studies are in overbought territory and signal some corrective action ahead. Only loss of 127.75, the intraday high of yesterday, would be risky and might soften the tone of euro-dollar. In this case, we might see the pair back to the weakness and the possible extension down to 127 and likely to retest 126.60, 65 lows. For now, the hourly studies are in the positive territory. However, overbought conditions on hourly and 4-hour are risking possible corrective action ahead of a fresh rally higher. Daily studies, however, are still in the negative mode, but slight improvement is seen at this point as the RSI is bouncing higher, with the 20 days moving average currently at 129.26, along with our other barriers, Fibonacci level and previous lows offering initial strong barrier. Would break here to provide relief for the single currency and allow for a stronger correction. Cable is still under pressure after losing the key support, better seen on the hourly chart, at 153.60. This was the November to January consolidative range floor, extending losses close to 152.71, our key support low of 2011, posted on 6th of October, as the losses extended to 152.78, just ahead of 152.71, where the temporary support was found. Current corrective bounce is seen just corrective, and there are not stronger expectations for some more serious rally. However, the regain of 154 might signal some recovery. 155.00 actually is our main barrier at this point, and while holding below here, the current bounce is seen corrective. Positive is the regain of 154.00, but still 154.17, the main bear trend line drawn of 156.68 high of 2012 is still intact ahead of 154.45 consolidative near-term consolidative range floor that is capping the upside for now. A break here and a regain of 155 would provide relief for the cable and look for a stronger recovery. Until then, pressure remains at the downside with the possible loss of 152.78, 152.71 to open way for further extension lower with the 150 zone to come in focus in the short term. Dollar yen is also at the back foot after unsuccessful attempt to regain 77 zone 2 days ago, and subsequent reversal losing the initial support and higher platform at 76.75, extending losses to 76.66, just ahead of our 76.60.50 main support in the current structure. Yesterday's low at 76.66 gave some support as the pair attempted to recover, but this was short-lived as again stalled at 76.83, and now fresh attempt lower is testing the yesterday's high with the possible loss of 76.50 support low of 18th of November and 4th of January to risk further extension lower with 76.10, 76.00 to come next, ahead of record low and pre-intervention low of 75.56. Important to mention again that position of yen is current weakness, current strength of yen gives signals to the Bank of Japan for possible intervention, as possibility of action of the Bank of Japan is seen on the loss of 76.50 support. Nothing is still confirmed, but action from central bank is pending, and we might see possible intervention in case of further strengthening of Japanese yen. The dollar Swiss is also under pressure as failure to regain 96 resistance triggered corrective pullback. We are currently in the third leg lower from 95.00. Significant is the lower top at 95.65, and fresh weakness that broke below previous low at 94.63, accelerating losses to 94.10. This was the low of yesterday, with mild correction being capped at 94.50 zone, limited by 20 days moving average. 94 zone is also the 20 days moving average on the daily chart, and currently the pair is attempting to break lower. That would open way for a stronger correction lower, and likely to expose the 93 zone, which is the higher low of 3rd of January, and the risk of full retracement of the recent rally from 93.03 up to 95.93 is now quite high. Of course, in case of break of 94.00 firm break lower, the 4-hour studies are in the negative territory. RSI is entering oversold zone, while the hourly RSI is already deep in the oversold at 1994, while MACD is below the control line and the momentum below 100 center line. So negative sentiment persists on dollar Swiss, and as I said, on firm break of 94.00 we might see extension down to the next significant level at 93.00. On the upside, the overnight's corrective high at 94.50 offers initial static resistance ahead of a dynamic one at 94.39, which is 20 days simple moving average. Above this we have 94.63 higher low of 10th of January, and basically regain of 95 would provide relief with the clearance of 95.65 to refocus 96. For now, this is out of reach unless intervention occurs, as the Euro Swiss lost 121 mark, and this might prompt possible action of Swiss National Bank, as they acted the last time when the peg was put at 120 and they intervened. We need to keep watching the dollar Swiss and the Euro Swiss, as I said, the action from Swiss National Bank is still pending, and it's quite likely, if they continue the policy of higher peg of the Swiss franc in order to prevent further strengthening of the Swiss national currency that is directly threatening Swiss economy. From commodities, brief outlook on the gold. As we can see on the daily, the gold is still firm, holding above 200 days moving average on the daily chart, as dips, recent dips were contained here, and fresh high posted at nearly 1662 yesterday. A significant break above previous high at 1642, which also marked over 50% of actually 50% of the latest down leg from 1763 down to 1522, keeping the sentiment positive on the yellow metal. Near-term action, actually, a near-term outlook is currently still in the negative territory, as MACD keeps holding below the center line, and the momentum is just hovering around the center line. However, the wider picture still maintains, as shown on the 4-hour chart, maintains the positive tone, as the 20 days moving average currently at 1641 contained the recent dips. Prospect is seen for further recovery of gold, with the break above 1662 high of yesterday to open Fibonacci level at 1670 approximately, which is 61.8%, and 1677.85 high of 13th of December. On the downside, initial support at 1634, yesterday's low, ahead of a strong support zone at 1600, only loss of a break below here to weaken the structure of gold. Crude oil remains at the back foot after hitting a fresh high at 103.72 a couple of days ago, 5th of January, continuing to descend lower, unable to regain this level, with several attempts stalling just below 103.39 and 102.96, with the latest sharp decline, losing initial support at $100, extending losses so far to 98.49. Current bounce is still seen as corrective, as long as I would say 100, minimum 100 stays intact, where the 20 days moving average on the hourly chart stands for now. 100.17 was seen so far, but oil unable so far to regain this level. However, firm break here and clearance of 101 level, as well as 101.44 20 days moving average on the 4-hour chart would improve the sentiment. And it's also important that 98.28 low of 29th of December, also 50% Fibonacci retracement, stays intact for now. That would keep prospect for a further gains. However, on the near short term, the outlook for crude oil remains still negative, as long as levels at 103, 103.20 cap the upside.